There are two types of traders when it comes to fair value gaps: those who profit and those who become liquidity. What is the key difference? Profitable traders know which fair value gaps to trade and which to avoid. Not every fair value gap works. In this video, I'll reveal the 5 strongest types of fair value gaps that you can rely on. I'll explain each one, show you how to use it, and provide a full strategy with examples. This is premium content, but it's completely free for you. Let's begin. Now, the mistake that people do is looking for every fair value gap as it's going to start an expansion, right? When in reality, not every fair value gap works. And we need to be picky when it comes to fair value gaps because market is fractal. You can see a 4-hour fair value gap and then a 15-minute and then a 5-minute. So which one is going to work? That's why we need to focus on limited types of fair value gaps and specific patterns. So we need to focus on fair value gaps that start expansion instead of consolidation. All right, consolidation will lead to liquidity, so we're going to have liquidity that is happening inside of the fair value gap instead of expansion, and that is the focus for today. We want to focus on expansions. And then also the same thing with fair value and imbalance. Not every imbalance is a fair value gap. There is a difference between the two. So imbalance in general, we want it to be felt regardless if it wants to go in the same direction or it wants to be disrespected. When it comes to fair value gap, it means that we want to continue in the same direction. So usually when I have a fair value gap, and this is the one we're going to be focusing on, we want to establish expansion in the same direction of the fair value gap. On the other hand, imbalance, it just like a magnet, it needs to be filled. We can target that zone instead of just entering from it. All right, and this is the same as the difference between liquidity sweep and liquidity run. Liquidity sweep is looking at that high or low, that specific high or low, to be swept. So we're going to be faking out below that low, for example, and then continuing in the same direction, which is the bullish side. However, liquidity run means that in the first place, we are targeting that low, first of all, as a drawn liquidity, then taking the liquidity from that low and continuing in the same direction. So same as this. This is the low. We take the liquidity, we continue to the same direction. That is the difference between liquidity sweep and liquidity run. In simple words, liquidity sweep means reversal. Liquidity run means continuing in the same direction. That can also be applicable on the fair value and imbalance and the difference between the two. We're going to be focusing only on high probability fair value gaps that actually start expansions. First type of fair value gap, that is the first one, and probably you've never heard about this type of thinking when it comes to fair value gap, and it all comes from my hard working. So I do sit in front of the charts for hours and then discover some things that I've never had an answer from YouTube, from anyone else. So you have questions to yourself and you'll find the answer by yourself also. The first one would be a fair value gap overlapping with time and price levels. All right, a lot of people talk about time and price and how they're related to each other, and price comes first and then time, whatever, time comes first and price. I don't really care about all of that. I don't have a specific theory, but I know that both time and price are important, and I also believe that they're kind of equally important. Now, everyone has his own opinion, and that's totally okay. That is mine. Fair value gap, and we have 3 here, and let me tell you that we don't only have 3, we have much more than 3, and in my head now I can think about 5 more specific fair value gaps that happen at a specific time, and I take advantage of those specific time and specific price levels every day, and those ones are going to be high probability ones. I'm not going to reveal all of them today. The reason is simple, because I want you to finish the job, finish the work. I want you to take those 3 as inspiration and go do it yourself. Okay, that's going to, maybe you'll realize things that I've never came to, right? So the first one would be fair value gap around midnight open, and that is in EST time, that is in New York time. Fair value gap around the midnight open. So you're gonna mark your midnight open on the 15-minute time frame. The candle that opens, you'll mark the opening, and you want to look at a creation of fair value gap around that level. Any fair value gap created around the midnight open it's going to be kind of a high probability. And why? Because the midnight open itself is a very significant level. It can push price lower, push price higher. Now imagine that there is a fair value gap there, and that is also applicable on all the other PD arrays. If we have an order block also around the midnight open, it's also high probability. Another one is a fair value gap around 50% of the agent range. What you're going to do is go from 20 to midnight, and I want you to look at the range you have. So let's say this is the range that I have. I want to mark the 50% of it, and then look for a creation of fair value gap there. If it's created in the agent session, or about the ending of it, it's still valid. If it's created in New York or London, it's also valid. So any fair value gap around the 50% of agent range is going to be valid. Also, fair value gap, and you see how this one is related to price, also time. This one is time, and this one is also time. Fair value gap after quarter 2, which is the manipulation quarter. Now you could look at the the daily quarters, and that's going to be the ones created after 1:30 a.m. EST. That is the starting, almost the starting of the London session. You could also look at the 90-minute cycles of each of those big quarters. So the 90-minute cycle of the third quarter, the 90-minute cycle of the second quarter. So basically second quarter of the second quarter, and then second quarter of the third quarter, same like this. And I'm going to explain all of this in details, and we're going to have some examples. So this is just an inspiration to tell you that there is something that maybe no one taught you about, but it's really high probability. And this is an inspiration. I want you to do the rest, and maybe over time I'll reveal one by one. Let's cover some examples for now. So now, as an example, let's start with the pound dollar, and on the 15-minute time frame. First of all, let's look at this Asian range, and then we have a sweep above. As you all know, this is my strategy also here, and we're going to take a GAN box with the settings of 50%. So we're going to be focusing on this line primarily. Okay, now I want you to look at this 50%, and then the end of Asian is here. You can see that it's ending here, and already we can see the 50% almost about this level, because we already put a high here. Then we start just retracing lower. Now think about this, around the 50%, what do we have? Can I actually see that we have a fair value gap that is bullish. And what do you notice here? This fair value gap that is around the 50% pushed price higher, especially that this fair value gap has an inducement here. So we about that inducement and then pushing higher. We can apply the same thing on the minute open. You can see that is the minute open, fair value gap here, higher probability, pushing price higher a bit and then not holding much. We have this fair value gap that is also around the 50%. I don't usually tend to, extend the 50%. I do it for the minute open, but we can still see here that we have this fair value gap, minute open here, and then they don't overlap clearly. There's some better examples. Let's see here this day. I'm not sure if it works, but we can do it all together. So adjusting the agent session, actually it goes until here. That is the midnight, and then this is 20. Do we have any fair value gap around the 50%? This is 50%. You can see that we have nothing, no fair value gap. There is one below here. We can see that we have this liquidity level here, and price tends to go there. So it's applicable on almost everything. Now the same thing goes for midnight open. This midnight open, there is no clear, actually there's fair value gap here around the midnight, and this one push price higher, then went lower. There's no fair value gap here. We have a fair value gap here, but that is the next day. So we want the reaction, or at least price retracing to the fair value gap is immediate one. Now same thing here, midnight open to the low. Now we can put the agent session from the high to the low, and 50%. So you see how the agent session ended here. We have order block here, push price lower, and we can also do it with the midnight open. So we have a fair value gap around the midnight open. We have one here, actually one just below the midnight open. Give a reaction, and I don't want you to just rely on this by itself. I want you to look at the other types of fair value gaps and add this as a confluence. But in general, those fair value gaps around those levels are really high probability ones. Now same thing here. I want you to 50% here did not retrace, and you can go, for example, here you want to mark your minute open, put it to the right, and see, is there any fair value gap overlapping with it? In this case, no. But you see this order block here around the midnight open, really push price lower, and then we go up from there. In this case, I don't think Asian 50% give a reaction. Actually here, reaction 1, 2, and then 3, you see, all from the 50% of the Asian range. It's really powerful level. Same thing here. I don't want to go over a lot of examples, but you see here very nicely, and then we had news, so we put a wick and then going higher. Now this is the euro dollar, and you can see the same thing. Asian session 50%, actually right here, you see respective ones twice and then going lower. Same thing for midnight open. You want to put your midnight open fair value gap here, even though we had a sweep here, but it eventually goes lower. So I think probably you would be stopped out here. Now when it comes to the third one is using quarterly theory and using the second quarter of either the daily quarters or the 90-minute cycles. So using this indicator here, it's called just quarterly theory. It's actually this one, DQT. All right. Having this one is going to show you the quarters for the day. So as an example, you can see that the second quarter of the day starts at midnight, and then the second quarter of the day. So here, fair value gaps are going to be higher probability between midnight to 6. And then inside of it, this is the second quarter. This is by itself from this time from 1:30 to 3 a.m. This is time where fair value gaps are going to be high probability ones. And same thing for Asian. From here to here, so from 19:30 to 21, this is time if we have a fair value gap, it's going to be a high probability one. And same thing for New York. It's between 7:30 to 9 a.m. When we have a fair value gap at this time and price comes back to it, it's going to be a high probability one. And same thing here. So you see, this is the second quarter of the day, and then this is the 90-minute cycle, the second quarter of the second quarter. You see this one here? Do we have a fair value gap here? Not really. Maybe on the 5-minute you can see maybe one here, but prior to it there was a fair value gap, and this one hold. Usually I'm gonna be confused here, but this is another one from 1:30, all right, to 3. You're gonna look for fair value gap at this time, and if you go to 5-minute, you're gonna have a lot of I believe a lot of opportunities. So here to 3, you see fair value gaps at this time are high in probability. This is the fair value gap we want to trust. Okay, this time we had a week, I guess there was some news or something, but this is the trick, and this is the fair value gap that you really believe in it. And I want you to do your analysis first. I want you to follow all the other confluences that I'm going to go over. Use this as the last thing. The second fair value gap that I suggest trading, and it's really high probability, is a fair value gap that disrespected a PD array. And when we talk about PD array, usually what we're talking about is a fair value gap, because that is the one we're going to focus on the most. We have also order blocks and breaker blocks. We're going to talk about that in the next one. Now, before going into the fair value gap itself, we need to understand the manipulation types when it comes to fair value gaps. And if we have the two together, that's going to be the best one. Usually for this one, we're talking about this one. But if you blend it with the other manipulation, that is going to be a very high probability one. Starting with liquidity manipulation, and that is simply before creating that fair value gap, we need to see a sweeping of a high or low, and that is the external liquidity, obviously. And then another type is reaching a fair value gap, and that is the internal liquidity sweep. We can also have a PD array manipulation. And what does that mean? It means that PD array creation prior to the liquidity manipulation phase. And the reason and the intention of that PD array creation is to induce traders to enter in the wrong direction. So it's a trap to convince some people to enter in the wrong direction, especially people who just go and trade any fair value gap. They will fall into this trap, and that's why we need to avoid it. And that is just one type of manipulation to validate fair value gaps. So if we have a fair value gap that has two manipulation phases, then that's going to be a very high probability one. So when we talk about disrespecting a PD array, this is what we mean. We mean that price is going lower, and maybe we have sweeping here, sweep of liquidity, And then we have a creation of a fair value gap. This fair value gap here is one in the wrong direction. So manipulation, which is the PD array 1, and then we have a sweep here. This sweep here makes this low probability. All right. And then what happened after is we create a fair value gap that is with the direction, with the liquidity sweep. This fair value gap now disrespecting also this one because we closed. You see here this candle closing above the fair value gap. That is disrespecting the fair value gap by a body closure. And then we create another fair value gap. This now becomes a very high probability fair value gap. And why? Because this one disrespected a PD array, which is this one, this fair value gap. And usually this can be sometimes a balanced price range, which I have a full video about and a full strategy about. I suggest watching it. So balanced price range is basically two fair value gaps overlapping with each other, either part of it or fully overlapping. And now let's go over some examples. So looking at the euro dollar 4-hour time frame, you can see in this specific situation here, and again it happens on any time frame, but you need to see really disrespect of the fair value gap fully. So it's not like this where we create, actually there's no fair value gap here. Okay, where's one? Yeah, so this one here, we create a fair value gap, but we did not disrespect this fair value gap still. You see, eventually we go lower and then we go up after. So this fair value gap was not totally disrespected. However, this one, and I really prefer to look for singular fair value gaps, but you see how this fair value gap is a manipulation 1, a small reaction from here, and then a closure above. When we have that closure above, you can see that we create another fair value gap here. This is one that you can trust. See, entering from this one, and then maybe stop below here, and that is a winner. All right. Now, same thing. If you go and look for fair value gap created on one direction, then disrespect of it, and creation of another fair value gap, as an example, this one. See how fair value gap to the lower side, fair value gap to the upside, and this one disrespect this previous fair value gap, then this one is valid. However, price does not come to this fair value gap immediately. I don't know if it takes time, but it takes time, and here consolidation disrespecting with news. Now I want to focus again on those types of fair value gaps where we have fair value gap here as an example, and same thing here. Now on the 4-hour, in specific times, price will not retrace back to those fair value gaps, but in other times it's gonna go back and respect. And you can test this on the 15-minute time frame, and as you can see here, fair value gap to the upside, 1, 2 fair value gaps to the downside. If you take the second one, right, or you take maybe the hidden order block from here, actually it's not valid, I guess. We have this fair value gap respected here. Now you could look for the PPR indicator, and it's gonna mark some balanced price ranges for you. Usually with a balanced price range, there is a manipulation of a fair value gap and then disrespect. So here, this one, see, we disrespected all those fair value gaps. We have one here, and this balanced price range was a snapper entry. Now you could look for this one obviously failed. We have this one here, we have this one, the one we talked about where news wicked up, and we have multiple ones here. So the balanced price range will help you, but you can do it manually with no indicators, and it's gonna be really high probability, and even on the 1-minute time frame. And it works the best in indices, better than anywhere. So you see here, actually, this is one that is real time. You can see that we have this fair value gap where we disrespected it, and then going up, creating another fair value gap. Fair value gap here, balanced price range here, it get respected from here, especially at specific times. So if you can see, what is the time here? You can see the timing is 1:30, 2, 3, about to become 3. So you see this timing here? This is the second quarter of the day. That is a valid fair value gap to look for. Same thing here, that is happening real time. However, this is a bit not in discount. Now into fair value gap number 3, and that is the fair value gap overlapping with another PD array. You know that one thing, or in other words, one confluence is not enough to enter a trade. So when we have 2, 3, 4 confluences at the same time, the more confluences usually is equaling to high probability trade. So why only focusing on one PD array when we can have 2 or sometimes 3 overlapping at the same zone, and this zone now will be a high probability one. Why? Because we have 2 or 3 things pushing price higher or lower instead of only one. So one of the fair value gap that we can trust more, and it is higher probability, is a fair value gap with another PD array, and usually it comes with fair value gap and order block, as we can see here. And usually those two that we're going to be discussing today, so this one here as well as this one, those are kind of connected to a market structure shift. So when we have this overlapping, usually it is followed by a market structure shift. Most of the time, I'm not going to say all the time, but most of the time, there's either a change in state delivery or there is a market structure shift. So first of all, the fair value gap and order block, we can see that here we're going up 2 consecutive bullish candle, then 1 singular bearish candle, and then it was engulfed in those 2 candles, and then third candle comes here to complete the 3 candle pattern, which is the fair value gap. So you have a fair value gap here, and now we have a fair value gap as well as an order block and an information, and I also have a full video about trading order blocks, so if you're curious about that. Now the order block and the most sensitive zone in the order block is in a bullish scenario. So we have this bullish order block, it's the last bearish candle, this here, or it's the bearish candle. So this bearish candle is an order block. The most sensitive zone is from the wick to the body, and usually it's the body, but sometimes price can react to the wick too. So this zone here, I would actually mark this, and you see how this zone here overlaps with the fair value gap also. So this zone here is the high probability zone, and when price comes here, it's really high probability in order to push higher. So we have 2 PD arrays overlapping at the same zone. That is a high probability fair value gap. We also have a fair value gap and breaker block. The only difference here is we're focusing on the consecutive bearish candles. So you see how we have bullish candle and then 3 bearish candles and then engulfing here. Now, if you notice, we have 1, 2, 3. That is a 3 candle pattern confirming the fair value gap here. This now from here to here, that is the breaker block. If you focus at the wick here, also the body, and then this zone here, this is going to be a high probability zone because now we have 2 PD arrays pushing price higher instead of only one. Now make sure you look at the other confluences here. Sweep, sometimes you have a BPR also, a balanced price range, and fair value gap, and a breaker block. Now we have 3 confluences. Now it becomes higher probability. Let's look at some examples. Now this is the euro dollar on the 1 hour time frame, and we have a lot of examples that we can find here. I mean, if you go and take a look at this as an example, you can see that we have this fair value gap here, and then we caused a market structure shift around this point, closing above the wick. So now we already have the breaker structure, all right? And then inside of here, we can see that the high, and this is a trick that you can follow, when you have the high is not overlapping with the fair value gap, obviously the wick, we can look for the body, and you can see this is body, and we have a fair value gap here. So we have, as you can see, 2 things overlapping with each other. So now this zone by itself becomes a high probability one, and you can see at the end of the week, price comes here, and then it opens higher. So basically, it respects that fair value gap. And same thing here, if you can see, and this one overlapping with an order block. You can see this singular bullish candle that was engulfed later. This one here is a high probability one. So you see fair value gap, then it respects that order block exactly there, and then it pushes lower. So it gives you about from here to here about 25 pips. Now you can apply this every time. Obviously it does not work every time because it's not only about the overlapping, it's about how valid the fair value gap is. But obviously you can see here order block, fair value gap, that is where price comes to, and then it goes lower 55 pips. Now you can look for this also here. You can see how even though we don't have a market structure shift here, so still no market structure shift until here. So here it's confirmed. Now you look at your fair value gaps. Where do you have a fair value gap here? Obviously this is a fair value gap because the wick now is outside and not overlapping with the fair value gap. We can take the bodies, and here this is the body, and that's price coming here and then pushing higher. Now again, same thing. You can see breaker structure here and then a fair value gap. Now we have the wick overlapping with the fair value gap. When we see this, again, we can mark this zone here from the wick to the bodies, and this is a very sensitive zone that we can trust more. So you see, price comes to that zone and then pushes higher. Now this happens all the time, either the consecutive candles or a single candle. It happens all the time. Now sometimes price does not retrace, but as you can see, I think around here we had a perfect example also. So you see how this fair value gap here overlaps with this wick and body, and you see that's where price comes. For some reason it did not hit the body, so maybe some of you will miss this trade, but it comes to the wick and also it comes to this hidden order block, but I'm not gonna say this is the highest probability one. But overlapping is the key. If you really want to be on the right side, look for a market structure shift and then an order block, which is one singular candle, and then look for either a breaker block or an order block and sometime a mitigation block. Perfect example that you can see also here. I'm not gonna go over a lot of example, but you see clear breaker structure here. You want to mark this zone here from the body to the wick, and obviously this is where price comes and then it pushes higher for 36 pips. The fourth fair value gap is going to be a fair value gap with inducement. Now I do have a lot of videos about inducement. I don't want to start over in every video. I do have multiple videos. Just look up Mulham Trading inducement and you'll have a lot of explanation about it. Now the types of inducement that we're going to be focusing on today, type 1 here and then type 2 here. Now think about inducement in the, I would say the simplest word is the first mitigation or the trap for the early buyers or sellers. Now think about here, you can see that this fair value gap right here, and sometimes we want to focus also on the overlapping. So if price does not come to the overlapping, you can look for that, but in this case we're just focusing on 50%. To see how this is the 50% of the fair value gap, price comes here, comes to the beginning of the fair value gap and then pushes higher. Now think about a lot of people looking for confirmation. They're gonna look for the confirmation here, maybe here, and then they're gonna enter. Let's say this is 15 minutes. They're gonna enter on the 1 minute here and stop loss up below the low. That is an inducement trapping early buyers and sellers, in this case buyers. Now price goes up, this is the first mitigation, not going to 50%, maybe not going to an overlapping or not BPR, a lot of conditions and different conditions. Now what happened is now, because we have this first mitigation, this fair value gap becomes high probability. Why? Because we're trading internal and external liquidity at the same time. Internal liquidity is the fair value gap itself. External liquidity is the low inside of the fair value gap in this case. So sweeping that low, this is the zone. Now we want to focus on this low inside of the fair value gap. Now this fair value gap becomes high probability one. And if you don't understand this, I suggest watching the other videos, because I always recommend doing this as well as waiting for the examples. Now another scenario, this is type 2, I would say, is not a low inside the fair value gap, but a low above the fair value gap. This now is an inducement. Why? Because as price was going up, price comes very close to the fair value gap, but then it tends to go up and then it fixes, or it induces a lot of people to motivate them to enter early instead of waiting for the zone. Now a lot of people with FOMO would say, oh, you know what, we're gonna enter regardless if the fair value gap is filled or not, and then it's gonna go up and they're gonna be happy, stop loss below the low. What's gonna happen is price coming back to the fair value gap, sweeping that low, and same thing, internal and external liquidity. And this one is better when it comes to the internal and external at the same time, because the internal is still not taken. Internal here is already taken. So this one is better when it comes to internal and external liquidity focus. All right, so sweep on that low above fair value gap. These two fair value gaps are very high probability ones. Now some examples of inducement. The first one that I can see here is this one. So we have a fair value gap here. We had actually a sweep and then creating of a fair value gap. Price comes here for the first time. A lot of people would be able to trade this, but actually this one is just the opening, but not a lot of people would be trading here because this is when the market is starting a new daily candle. But we have this low. Now this low here is inside of the fair value gap. I'm not going to say this is the perfect example, but I want you to still learn from it. All right. So you have this low. Some people maybe entered here, and then price comes very close to the low, did not take it. So now we have equal lows. What happened after is a lot of people thinking that now it's time to go up. Yes, it went up, but you see what happened after is price still wants to go up more. It took liquidity from the fair value gap until it fills the fair value gap fully, and then it started going up. Now think about it the same way. You see how here we have a fair value gap. Price comes here for the first time. So you can see we have the first touch, and sometimes it gets messy. It gets complicated. You see how it comes first, and then you see how many times it induces people sweeping almost 1, 2, 3, 4 times until it fills the fair value gap fully, and then it start going lower. Now think about it also this way, and this is another example. We can see this fair value gap here, fair value gap that is bearish, and then we had a break of structure here, or market such a shift, whatever you call it, and then we have the first mitigation here. As I said, first mitigation is a lot of times an inducement. You see, first mitigation, this is the high. What happened after? Sweep of that going lower. And if you watch my previous video about how to find high probability liquidity sweeps, you would notice that this high here took this low, which makes this now again an inducement, because a lot of people think that they look at patterns as strong highs and strong lows. This one took this low. It's also an inducement, and you see for the second time price comes here, and then it failed to go lower until we had another sweep here. Now why this one was the time for price to go lower? What is the reason? Now you got to understand daily profiles. You got to understand when we have news, because that's when the manipulation would end. Actually would start and end at the same time, and the distribution would start. But also look at this. Look at the power of fair value gaps, and look at the power of also overlappings. Now we have a fair value gap here, and then we have one here. Maybe on the higher time frame, you would see a singular fair value gap, and this singular fair value gap here, I mean the one that I'll start first is the lower probability, which is this body here of the order block. You can see that price comes there and reacted from there, so price had to go to the order block. But the other thing is, look at me dragging this rectangle to the right. See, first mitigation, second, third. I want you to see what is the only difference that fourth time did. The only difference is this: until here, the fair value gap was still not fully filled. However, this candle filled the fair value gap fully and then started pushing lower. That is the difference. Now fair value gap number 5, and that is simply a fair value gap that aligns with the higher time frame POI, and that is what a market maker's model is about. When it comes to market maker's model, what we're focusing on is a fair value gap, and then we want price to come to that fair value gap, give us a change in the direction, and then a fair value gap with that direction, and we trade from it. Same thing here. So let's say this is a lower time frame bearish fair value gap, which is this one here. This one, when we're focusing on this higher time frame POI, as you can see here, this is a fair value gap, higher time frame fair value gap. Price comes here. You see how this fair value gap is a bearish one when we're in reality coming to this bullish fair value gap. So we're not taking this one. This is only a manipulation fair value gap, and I've talked about it multiple times. What happened after is with the alignment, and this is the time frame alignment. So if you're using daily time frame, look for 1 hour time frame fair value gap, 4 hour to 15 minute, and then follow this time frame alignment here. The higher time frame bullish fair value gap, if it's bullish, again this is a bullish one, we look for a bullish fair value gap on the lower time frame. That's it. If we have this alignment, this fair value gap here becomes high probability, this becomes high probability, but you need to also apply the other confluences. If you have this fair value gap here and another one here and one here that has an overlapping, I would take this one. This is what a market maker's model is about. That's it. It's a higher time frame POI looking for a lower time frame POI that is in alignment. And I do have a full course, consists of 2 long videos about market maker's model and everything you might need about. Just look up Mulham Trading Market Makers Models course and you'll find it. Let's look at some examples now. So an example on the fair value gap that is created after price going into a higher time frame POI and a higher time frame fair value gap. So fair value gap created after another higher time frame fair value gap. One of the best examples that I actually traded is this New Zealand dollar trade. We can see now this is a 4-hour time frame, and again, when it comes to the alignment, it's going to be 4-hour to 15-minute. All right, so this is the time frame alignment. Go back to the slide and look for your time frame alignments. So if you're using the daily, then look for the 1-hour fair value gap. Now, what do you see here? We can see this big fair value gap. At least when I have those types of fair value gaps, I want to focus on the 50% of that fair value gap, at least, right? So taking this, we can see 50% is around this level. Now, if I want to refine more and I want to get very nice entries, and if I want to stay on the highest probability conditions, then I would look for the overlapping, and we've talked about this already in the video. So we have one overlapping here around the 50%, slightly above. I'm gonna mark the wick to the body and take it to the right. Now, if you refine it more to the order block, it's going to be this one. This is your order block here. You have 2 bullish candles, bearish candle, 2 bullish candle, and then bearish candle. This is my order block here. This is the one that I'm gonna look for. So we have 2 zones here. We have this one, this one. It's your choice to take any of those. We're gonna switch to 50-minute time frame, and now look at the reaction of those levels. So you have this one here around, I would say the fair value gap is created 13. So 1 p.m. I don't think I'm trading at this time. If you're trading, it's not gonna be the ideal one for Forex because we focus more on kill zone, but it is, if you take this one, or if you trade at any time, then you take this one and it's going to be a low. So I'm gonna maybe take it from the balance price range, so around here, or the hidden order block, and that is obviously a loss. Now what happened after that is actually also this time is not the best time, but you can look for the continuation. You can see how we come to that zone with a wick and then we start pushing lower. So one fair value gap here, which does not get filled, second fair value gap, and now we have 2 fair value gaps, consecutive ones. We have a hidden order block here. If you're not familiar with it, then make sure to watch my video about hidden order blocks. Usually when I have 2 fair value gaps, I would focus more on the start of the hidden order block or the 50%. Hidden order block here, price comes here, and then you respect that one. Now look at this one. Now you are in a market maker's model. So you see going up and then pushing lower. Now look at this. We have another creation of fair value gap, all based on the same order flow. You see, another fair value gap respected. We have another one here, and it's also respected. As I said, it's all market maker's model. And then we push lower. Back to the 4-hour time frame. Now, I want you to see this fair value gap here also. It's a big fair value gap, right? Now, at least I want to look at the 50%. So 50% is around here actually, a bit too low. No, actually it's to here. So that is the 50%, right? Prices come to the 75%. Now, what overlapping we have with this fair value gap? You notice we have this first one, which is one of the obvious one, is this low created by this high, and then we took the low. So the highest high between this low and this one is this one, right? And we mark the body to the wick. If you want to refine it more, then you can look for the bodies, right? It's your choice. We have another one maybe here, but I'll keep an eye at this one also, right? This one here. Now price comes obviously to this one, to this level, back to the 15-minute, and I want you to notice what happened here. Actually, even if we focus also on the bodies and wicks, so all together, gonna be this one here. That is the zone. We have 2 zones. We have the refinement of the body, and we have the body to the wick. Back to the 15-minute, and we want to notice what happened here. Actually, when price comes to the wick, it comes to the wick, and then it started going up, creating another fair value gap. And what do you notice? Exactly at that time, price created the fair value gap and rebalance it, and then started pushing higher. You see, that is a valid one. Now you see, after that, price takes that low, which is almost the Asian low, and comes to the refinement, and same thing. What do you notice happening? Fair value gap created here, and then pushing higher all the way to the other fair value gap. So that is how we can trust the fair value gap that is created after coming to another higher time frame fair value gap. So that's it for the video. I hope you guys like the video, and it's going to help you with picking the right fair value gaps. If you think this video would be helpful to other people, especially people struggling with fair value gaps and losing with them, then make sure to share the video with other friends, like the video, leave a comment with whatever video suggestion you need in the future. This is Mulham, and I'll see you next video. Bye bye.